Good morning. I think we should get going. It's 11 o'clock and we've obviously got a bit to do this morning. So I'm going to, as usual, run through a bit of news first. Not very much going on in the sector this week, thank goodness. And then we're going to get to the panel. We've obviously got some people lined up to wait to talk to you. So this week, a couple of things. We've got a merger going on between New River REIT and Carthew Regional. We've talked a bit about before, so I'm just going to run through what's going to happen. And then the cost disclosures, which is quite a big thing for the sector. And something that I thought we were going to talk about this morning, but actually probably still will. So New River REIT and Carthew Regional first. Both of them hit quite hard from COVID, as you can see there. These are 5-year charts. Not massive companies, 250 million and 144, both trading on really reasonable discounts and quite high yields. And that's because really they're invested in retail property, and retail property has been one of the things that's been very much out of favour. So we actually got a formal bid announcement on the 18th of September when New River is going to buy Carthew Regional. It's a cash and shares offer, and it values at the current prices the Carthew Regional about 65.37p per share. And obviously that's going to fluctuate as the New River share price goes up and down. Interestingly, because quite often when you get these merger things announced, you get merger arbitrage. Well, they sell the bidder and buy the thing they're being bid for. These shares have gone up since 22nd of May, since they announced they were going to do this. I think maybe that means the market likes it, but also things have been going in its direction with interest rate cuts. Carthew Regional shares are way above where they were, so this is quite good news for them. It's not a bad fit. It's basically community shopping centres and retail parks, some regeneration opportunities. They also run some asset management stuff for third parties. And it's about £900 million worth of portfolio with about 10% yield on it. So that's quite chunky. There's some cost savings, which will help with the dividends. It's still reasonably indebted, but the weighted average cost isn't huge, 3.5%. It looks like this is going to happen. The largest shareholder is on side as Growth Point. They've said they want out. So I'm guessing they'll be favouring the cash side of things, but we'll see what happens with that. It's New River bid is now the only one on the table. There's a bit of a hit to the Carthew Regional valuation. So New River says that we don't think the valuations are quite as high as you say they are. So they're saying they could buy stuff on about 74.3 net tangible assets, which means still they're buying assets on a discount. They've already placed some shares. They haven't started trading yet. They trade it on Monday, but they've already issued 50 million quid worth of shares to fund this. So I think this is all going to happen. Cost disclosures next. So brief history of this is a complicated topic. It dates back really to when we were in the EU. The EU introduced some legislation. AIFMD was about how investment management works and how the charges work and everything else like that. And MiFID II in 2018 set out the rules around how you disclose those costs. And it was all about aggregating costs, all of the costs that go into an investment. And it puts it into a single figure, and that figure is used by all professional investors and they're to report to their clients. The effect of this was that funds of funds looks very expensive, but it was completely misleading because they're basically forced to include costs that they would no control over, no benefit from, no direct benefit from. And it made trusts look quite expensive to use, so wealth managers basically stopped using them. So a lot of them just stopped buying them, and then some of them just actually started selling them. And that was true also of funds of funds. And this was particularly true when UK consumer duty rules came in, because the whole thing about you're supposed to weigh things up for the benefit of the consumers. And it meant that platforms then said, well, actually, we're not going to allow investors to buy products that we think are expensive. All of this is completely misleading and wrong. So a whole bunch of politicians went into battle on behalf. In the House of Commons, John Barron. In House of Lords, Baroness Altman and Baroness Bowles. Baroness Altman put forward a bill to try and remove trust from AIFMD. That got its third reading, so it's a long, painful process, and it's impressive that they got that far. And it would have then gone to the House of Commons and hopefully become law, but the Conservative government called the election and that derailed the whole thing. And frustratingly, all the way through this, so we're being told over and over again, you need to get this sorted, you need to get this sorted, and they didn't. And so it just fell to the Labour government to do it. And now we have some action, which is great news. And the key point of this statement, I think, is talks a lot what we're going to talk about this morning, is they want to reinvigorate UK's capital markets. They're conscious that things aren't as rosy as they should be. And they're also keen that retail investors don't make investment decisions based on wrong information. So the regulations are all around this PRIP stuff. It's not hard and fast yet, but while they sort out how the regime is going to look, they won't penalise you for ignoring the existing EU rules, which is obviously good. And in terms of the practicalities for trusts, we don't have to worry about kids anymore. These are the documents that have these really weird cost charge numbers in, and that can get completely misleading. We said for ages don't make any sense. So we can just stop publishing them now. If you've got them on your website, and take them off. You don't have to update them. And when you're a wealth manager or anybody else buying an investment trust, recognizing the fact that the charges are already reflected in the share price you're paying, you now don't have to do any cost at all for them in the statements that you make to your clients. So that would be completely sort of zero charge. And you don't have to put the cost figure based on PRIPS methodology in your fact sheet. And in terms of this one single number that goes into the template for reporting on charges, that can just be completely zero. That's going to make a massive difference, I hope. At least it hopefully will stop people selling on the grounds of charges. And then hopefully we're going to get some buyers back again. So fingers crossed, that's what we'd like to see.